Wall Street is in turmoil. Recession fears are rising in the US, and President Donald Trump is making it worse. American stock markets lost over $1 trillion yesterday.
Annexation of Greenland and getting the potential.
Yeah. Well, I think it'll happen.
The US stock market just experienced one of its most dramatic collapses in recent history, erasing a staggering $1.7 trillion in market value within 24 hours. Major corporations, including Apple, Nvidia, and JP Morgan, saw their stocks plummet by 5 to 6% in a single trading session. But what's truly remarkable isn't just the scale of this financial catastrophe, it's what triggered it. A single announcement from former President Trump regarding military presence in Greenland sent markets into freefall. The question is, was this merely a coincidence? Or is there something more strategic behind this timing? What appeared to be a routine trading session on Wall Street quickly transformed into a financial catastrophe of historic proportions. The market's descent began gradually but accelerated with alarming speed as news of Trump's announcement spread through trading floors. By day's end, the financial damage was severe. The Dow Jones had plummeted by 540 points, while the broader S&P 500 approached correction territory, signaling a profound shift in market sentiment. The timeline of events reveals the systematic unraveling of investor confidence. Trading began with modest fluctuations, but a distinct turning point emerged approximately 2 hours into the session. At this critical juncture, the selling pressure intensified dramatically as major institutional investors began executing large-scale liquidation orders. Market analysts noted this wasn't typical profit-taking, but rather a fundamental reassessment of risk across multiple sectors. The technology sector bore the brunt of this financial storm, with the Nasdaq experiencing a devastating 4% decline, among its worst single-day performances this year. This disproportionate impact underscores the tech sector's heightened vulnerability to geopolitical developments. Traditional industrial and consumer staples sectors, while still negative, demonstrated greater resilience, with losses averaging 1.5 to 2.3%. Examining the specific casualties reveals concerning patterns. Technology giants became primary targets, with companies holding significant international supply chain exposure suffering the most severe devaluations. The vulnerability of tech companies stems from their complex global operations and dependence on stable international relations for both component sourcing and market access. Arctic resource development projects, particularly those involving rare earth minerals essential for semiconductor manufacturing, appeared especially susceptible to the geopolitical implications of Trump's statements. Perhaps most alarming for market analysts was the breakdown of key technical support levels. The S&P 500's breach of its 200-day moving average, a critical threshold closely monitored by technical traders, triggered automated selling programs and further amplified market pressure. This technical violation suggests a potential shift from bullish to bearish market conditions, raising concerns about longer-term market trajectory. Trading volume data provides further insight into the severity of this market event. The panic selling wasn't distributed evenly throughout the session, but instead followed an accelerating pattern. Volume measurements reveal modest selling in morning hours, with a pronounced escalation beginning around 2 p.m. Eastern Time. The final 2 trading hours witnessed the most intense liquidation pressure, with volume surging to nearly triple the daily average, a clear indication of institutional investors abandoning positions en masse. This market reaction represents a substantial departure from previous responses to Trump's public statements. Historical data indicates that markets typically demonstrate resilience to political rhetoric, often dismissing provocative statements as negotiating tactics rather than substantive policy shifts. Today's dramatic collapse suggests institutional investors perceive deeper implications in these latest remarks, concerns about fundamental economic stability rather than mere political posturing. Market analysts are now questioning whether warning signs existed before today's collapse. Several technical indicators had shown increasing market vulnerability in recent weeks, including declining market breadth, deteriorating advanced decline ratios, and unusual divergences between small and large cap performance. However, few anticipated that a statement regarding Arctic geopolitical positioning would serve as the catalyst for such an extensive market correction. The market's response pattern wasn't random or indiscriminate. Analysis reveals a distinct correlation between a company's exposure to international trade dynamics and the severity of its stock devaluation. Financial institutions with significant investment in Arctic resource development projects experienced particularly steep declines, suggesting investors immediately recognized the implications of altered military positioning in Greenland for resource extraction operations and territorial claims. Telecommunications and energy infrastructure companies with Arctic operations also suffered outsized losses, with several mid-size firms engaged in undersea cable projects or renewable energy development seeing their market values decrease by over 8%. This sector-specific impact pattern strongly indicates that investors quickly connected Trump's military statements to potential disruptions in Arctic resource development and territorial governance. The massive sell-off in Arctic-exposed companies wasn't merely a reaction to ambiguous geopolitical tensions. It was a direct response to specific military language that fundamentally altered the Arctic strategic calculus. When investors heard Trump's precise statement during his press conference, they immediately recognized its profound implications for regional stability and resource competition. The verbatim declaration, "We have a couple of bases on Greenland already, and we have quite a few soldiers, and maybe you'll see more and more soldiers go there," signaled a dramatic shift in approach that sent sophisticated investors rushing toward exit strategies. This military-focused statement represents a significant evolution in Trump's Greenland strategy. In 2019, Trump had pursued an economic acquisition approach, proposing to purchase the entire territory from Denmark, a proposition that was summarily rejected by Danish officials. That earlier attempt had created diplomatic tensions but relatively modest market reactions. The transition from treating Greenland as a potential acquisition target to viewing it as a military strategic asset fundamentally altered how investors evaluated Arctic-related investments. Security analysts note that Trump's statement carries particular weight because of existing U.S. military infrastructure in Greenland, including Thule Air Base, which houses early warning radar systems and space surveillance operations. By suggesting an expansion of this presence, Trump effectively signaled potential militarization in a region where Russia and China have already increased their strategic interests. The specificity of his language about adding more and more soldiers created immediate concerns about escalation in what had previously been characterized primarily as an economic competition zone. Market volatility intensified when, during the same press conference, Trump made the extraordinary suggestion that Canada would function best as an American state. This additional statement compounded investor anxiety by introducing unprecedented uncertainty about North American territorial stability, a region previously considered one of the most diplomatically secure in the world. The combination of increased militarization in Greenland and provocative statements about Canada created a perfect storm of investor uncertainty. Global security experts have long warned about the potential for Arctic resources to become flashpoints for international tension. The region contains vast untapped reserves of oil, natural gas, rare earth minerals, and other strategic resources that become increasingly accessible as climate change reduces ice cover. Trump's military statement was interpreted as potentially accelerating competition with Russia and China, both of which have been expanding their Arctic presence and resource claims in recent years. The timing of Trump's announcement amplified its market impact. It came during a period when institutional investors had been closely monitoring increasing tensions between Western powers and Russia over Arctic shipping routes. Chinese investment in Greenlandic mining operations had also recently increased, creating a complex web of competing interests in the region. Against this backdrop, Trump's military expansion statement was interpreted not as an isolated comment, but as a significant escalation in a developing geopolitical competition. Market analysts note that Trump's shift from economic acquisition to military posturing represents a fundamental change in how the United States might approach Arctic governance. Previous U.S. policy had emphasized international cooperation through forums like the Arctic Council, allowing for orderly development of resources and transportation routes. The suggestion of increased militarization raised the specter of a more confrontational approach that could disrupt established norms of Arctic governance and potentially lead to restricted access to key resources. The market reaction revealed how deeply integrated Arctic resource development has become in global supply chains and investment portfolios. Companies involved in Arctic shipping, resource extraction, and infrastructure development experienced the most severe valuation decreases as investors rapidly recalculated risk premiums associated with operating in a potentially more militarized region. This pattern of sector-specific impacts demonstrated sophisticated investor understanding of the complex relationships between geopolitical statements and regional economic stability. Beyond the immediate market reaction lay a more consequential development that few analysts anticipated: the unified front of international rejection that would ultimately multiply the market damage. When global leaders simultaneously condemned Trump's Greenland military expansion proposal, what began as a sector-specific decline transformed into a systemic threat to international financial stability. This coordinated diplomatic pushback created a multiplier effect that rippled through markets worldwide, extending far beyond Arctic-focused industries. The Netherlands delivered one of the most definitive rejections, with Prime Minister Mark Rutte publicly declaring that NATO has no role in supporting such an outrageous plan. This statement from a key NATO ally signaled potential fractures within the alliance itself, precisely the scenario that institutional investors consider high risk for global market stability. The Dutch rejection wasn't merely symbolic. It represented the first of what would become a cascade of diplomatic responses that transformed a regional controversy into an international crisis of confidence. Perhaps most damaging to market sentiment was the response from Greenland's own population. Survey data revealed an overwhelming 85% opposition to any American presence expansion in Greenland, with one resident pointedly declaring, "We are not a product for sale." This unified local rejection complicated any path forward for expanded American military operations, introducing fundamental uncertainty about the viability of Arctic resource development projects that had been factored into numerous companies' long-term valuations. The diplomatic tension triggered unprecedented volatility across international exchanges as Asian and European markets processed the implications. Frankfurt's DAX and Tokyo's Nikkei recorded significant downturns as investors recognized that Arctic territorial disputes could potentially disrupt established trade relationships and supply chains. This contagion effect demonstrated how rapidly localized geopolitical tensions can transform into global market events when they threaten long-standing international arrangements. What distinguished this market event from typical reactions to political rhetoric was the evidence of coordinated diplomatic pushback among multiple NATO allies. Financial analysts noted that this level of unified opposition suggested deeper concerns about American intentions in the Arctic region than had been previously understood. The diplomatic alignment among normally competitive nations signaled to investors that Arctic governance might be entering a period of protracted uncertainty, a scenario that traditionally drives capital towards safer assets. Canadian leadership's reaction further compounded market anxiety. When Trump suggested Canada would function best as an American state, he effectively expanded the scope of territorial uncertainty beyond Greenland to encompass the entire North American continent. Canadian officials swiftly condemned these remarks, creating additional diplomatic friction with America's largest trading partner. Investors recognized that any deterioration in US-Canadian relations could disrupt integrated supply chains across numerous industries, expanding the economic risk profile well beyond Arctic resource sectors. Currency markets reacted with particular sensitivity throughout the trading day as diplomatic statements continued to accumulate. The euro and Canadian dollar both experienced unusual volatility against the US dollar, reflecting investor uncertainty about the future stability of transatlantic economic relationships. Currency traders reported that hedge funds were actively positioning themselves for potential disruptions to international trade frameworks, creating a self-reinforcing cycle of market anxiety. The diplomatic pushback revealed an underappreciated dimension of Arctic geopolitics. The region's governance relies on a complex web of international agreements that presume a high degree of cooperation among Arctic Council members. Trump's unilateral military posturing threatened this cooperative framework, introducing systemic risk across multiple economic sectors. Investors quickly recognized that Arctic resource development, shipping routes, and environmental regulations could all face disruption if the diplomatic consensus fractured. What began as a valuation adjustment for companies with direct Arctic exposure expanded into a broader reassessment of geopolitical risk premiums across multiple sectors. Financial analysts observed that industries with no direct Arctic operations but significant exposure to international trade were experiencing valuation declines consistent with anticipation of broader diplomatic disruption. This pattern revealed sophisticated investor understanding of how regional tensions can cascade into global economic consequences. As institutional investors absorbed the ripple effects of Trump's Arctic policies, a more troubling pattern emerged beneath the surface. While equity markets took the immediate hit, bond markets were quietly sending their own distress signals. The precipitous drop of the 10-year Treasury yield to 4.22% revealed a classic flight to safety. As investors abandoned stocks for the relative security of government debt, behavior typically observed in the early stages of economic contraction, rather than mere market corrections. This bond market reaction represents more than momentary nervousness. It reflects sophisticated investors' assessment that the diplomatic tensions could translate into genuine economic risk. Financial experts have begun projecting that if the current policy trajectory continues unchecked, the United States could face a mild recession by late 2025, transforming what might appear as a temporary market tantrum into a genuine macroeconomic threat with lasting consequences for American households and businesses. The institutional response has been particularly alarming. Major investment firms, including BlackRock and Citadel, began liquidating equity positions at the fastest pace observed in 2 years, creating an accelerating cycle of selling pressure. This mass exodus from hedge funds represents more than routine portfolio rebalancing. It signals a profound vote of no confidence in near-term market stability that threatens to become a self-fulfilling prophecy as additional investors follow suit. The scale of capital withdrawal is unprecedented in recent market history. Approximately $240 billion exited the market within a single trading day, a liquidity shock that overwhelmed normal market mechanisms designed to absorb selling pressure gradually. This sudden withdrawal of capital exacerbated price declines across virtually all asset classes, creating a classic liquidity spiral where falling prices triggered margin calls, forcing additional selling regardless of fundamental valuations. Consumer confidence metrics collected in the 48 hours following the market collapse reveal significant deterioration in household economic sentiment. Survey responses indicate a 14% increase in consumers expressing serious concern about economic stability compared to pre-crisis levels. This rapid erosion of confidence threatens to impact discretionary spending patterns, potentially triggering a negative feedback loop between consumer behavior and economic growth that could extend the market crisis into the real economy. The Federal Reserve now faces a policy dilemma that extends beyond its typical mandate. Historical precedents suggest that when markets experience acute distress tied to geopolitical developments, monetary authorities often intervene with emergency measures. The central bank may now be forced to accelerate its rate-cutting timeline, potentially implementing reductions earlier than their economic models would otherwise indicate. This represents an unusual situation where statements about Arctic territorial policy could directly influence monetary policy decisions, effectively forcing the Federal Reserve to respond to geopolitical posturing rather than purely economic data. What makes this situation particularly concerning from a policy perspective is that the Federal Reserve's traditional tools for managing economic downturns are already constrained. With interest rates already low by historical standards, the central bank has limited room to stimulate economic activity through conventional rate cuts, potentially requiring more aggressive or unconventional measures should market instability persist or economic conditions deteriorate further. The growing correlation between geopolitical risk premiums and broader market valuation metrics suggests that investors are recalibrating their assessment of how territorial disputes impact economic outcomes. Arctic resource competition has transformed from a theoretical long-term concern into an immediate market factor, with investors now demanding higher risk premiums for companies with any exposure to international trade disruptions, regardless of their direct Arctic operations. Intermarket analysis further reveals deteriorating economic expectations. The gap between consumer staples and consumer discretionary sector performance has widened significantly, a pattern historically associated with anticipated economic contraction. Similarly, defensive sectors like utilities and healthcare have shown relative strength compared to cyclical industries, another classic signal that professional investors are positioning for economic deceleration rather than merely responding to short-term volatility.